Welcome back to the channel. My name is Brad, and today we're going to go through what's in my wallet, what did my 500K portfolio pay, and we're going to talk about a recession. Well, maybe a recession. If that's what you're looking for, stick around. So my name is Brad, and I've been retired now. Too old to remember. Not really. It's been about 9 months. Been doing this for a little while. August is when I started, for those new to the channel. But let's go through what's in my wallet. And this is everything that's in my wallet by tickers. So in my cover call, going into May, I have SPY-I, QQQI, IWMI, SPY-T, GIAX, FEPI, AIPI, T-SPY, GPIX, and GPIQ. Those are all my cover calls and call spreads going into the month of May. And if you're new to the channel, they didn't change. Looks like the exact same funds. Didn't sell anything. Didn't do anything. They're all the same. Now, I did average down, and we'll talk about that as we go through midway through the video. So stick around. Now, I have business development companies because I have 5 pillars. I got a large holding of PBDC and BIZD. Yes, I have large holdings. Now, if you're going to say their expense ratio, stop. Don't even go there. Go Google it. Don't make the comment. There you go. Easy enough. Google it. You'll find out that there's a thing about the business development companies, how they have to report it. That's all it is. So get over it. Move on with your life. Don't be threatened because of high fees of companies that hold other companies, and it's complicated. But if you need an article, go ahead and leave a comment, but I'm only going to post the article for you to go read it to figure out the expense ratios. Now, I started small positions in 6 business development companies. I picked these, and I've shown other videos how I picked them. Maybe I'll link it up there. I don't know what I'm going to do. I'll leave it down below in the comments. So I picked these 6. These are my 6. ARCC, BXSL, HTGC, Maine, OBDC, and TRIN. The drip is on. They're small holdings. I'm just taking a little bit of extra money that I have. We'll get into where did I come up with that extra money, and I put them into my business development companies. There you got it. That's where the money's going. Now I have alternatives. Kind of alternatives. I have BTCI, which is Bitcoin from Neos. I have Baggy. I have IYRI. I have AMLP, MLPR, MLPD, and MLPX. And those last 4 are master limited partnerships. And I already have target prices for MLPD to sell it. It's a play of when it gets up in price. I have target prices because it's a leveraged fund. I'm going to sell it. But in between time, I am collecting the distributions and just living off of it. But one day the price will go up and I'll sell it. And I already have those prices established. For members, you can go to the Google Docs and see those target prices to sell that master limited partnership on the spreadsheet. Now, preferred stocks. Gotta have some preferred stocks. I have PFFA. It's done very well. I'm very happy with PFFA. But it's gotten to be such a large holding that I went out and bought EIIA. Single holding. It does well. It pays me my 8%. I take my 8%. I bought it below par. So when they decide that they're going to call it away from me, they're going to pay me $25, which is good. I make a few dollars on that. It's doing well. And you can play the game of getting something like that at a good price. And I've looked at different ones. And maybe if I had a little bit of money, I might buy 100 shares of something else. But my wife is flying to Europe on Monday. Yes, Monday. And today is Friday when you're seeing this. So I bought an airplane ticket to Europe with 3 days notice for 2 weeks. And I'm paying hotel, airfare, rental car, food. You can just see how that made the budget for this month a little bit higher. But that's okay. We're taking care of some family business over in Europe that she has to go attend to. But everything is just fine. And because I have a significant cash, and we'll talk about the cash in a minute, it was no big deal. I also have senior secured loans and CLOs. EIC, and the best one so far is FSCO. It just makes money hand over fist. OXLC, JBB, SPMC, Clause, and JAA. So the ones in green that you saw throughout this presentation, all their drips are on. So those are the 5 pillars. So I have some REITs with IYRI, I have some Bitcoin, I have some master limited partnerships, I have covered calls, I have senior secured loans, private equity, and business development companies, all wrapped up into one little bundle. But today we're just going to expose what my $500,000 in covered calls paid me in the month of April / beginning of May. I received $7,237.19. I live on 8% of cost. And my cost went up from last month because I reinvested everything that was above. And actually, I reinvested about 80%. I took 20% of that and I put it into business development companies. So my reinvestment back into covered calls for this month was $3,640.11. I'll be flat out honest. It was probably closer to $3,600 because I don't get into the pennies. So I am not that retentive. I say, oh, it's $725 and I'll put $720 in just because I can. I always round down a little bit, have a little extra cash. Now, cash holdings, 11 months of cash. Just in case the next Great Depression comes along because, I don't know, you name it, it can happen. So I have cash. Don't need to use the cash, but I have cash. But that's okay. And JAA is part of my cash holding. Plus I have actual cash. And we'll get into why I have that when we talk about the recession. Now, let's go about spy-eyeing my cost and all the rest of them. So here's my cost basis. So my cost basis is $49.79. You can read them off. Those are my cost basis for each one of the funds. Now, when I reinvested 80% of after my 8, you can see how my cost basis changed per fund. You have it. FEPI went down 9 cents. AIPI went down 10 cents. T-SPY went down 3 cents. You get the thoughts. So I reinvest back in. Now, let's talk about 8%. I live on 8% of cost. Yes, I just breathed heavy because people still don't get this 8% of cost thing. And here we're going to use FEPI as my example. Last time I used SPY-I. We're going to use FEPI. 1 minus parenthesis 8% divided by 25, because FEPI pays 25%, means the price can drop 68%. And my cost basis at the time was $49.22. That means it can go down $33.47. That means it can go down to $15.75 for me to get my 8% on cost. Didn't follow that math? Let's do it a different way. FEPI pays 25%, and there's 12 months in a year, so that's 2.08% per month. Now, I need 8% per month, which is 667% divided by 2.08%, which actually equals 32. If I take 32 and times it by that 49.22, you come up with $15.75. There you have it. Now, due to my reinvestment, my new number is $15.72. But you go, and people will say this, but FEPI has never gotten that low. And my answer is no. Well, you know what the next word is going to be. No stuff. It's never gotten that low. That's exactly why I have FEPI, and I can average down. And you see my cost basis. Pretty simple. I can take my 8% because it pays so high of a distribution and reinvest the rest. So, Brad, what are you getting at? Where does this all go? Well, let's break it down for all the funds. So SPY can get down to 33.18, but SPY has never been that low. No stuff. Huh. You catch it on. QQQI, it can get down to $33.53. It's never been that low. Oh, now you're starting to see the picture. IWMI can get down to $28.47. Don't say it. I know you thought it. SPY-T can get down to $7.92. Wow. GIAX at my cost basis can get down to $6.40. And I would still get my 8% on cost. FEPI, $15.72. AIPI, $11.43. T-SPY, $14.55. GIAX, well, that's not a high payer. It can go down to $44.24 for me still to get my 8%. And GPIQ can get down to $33.59. Now you can start seeing the bigger picture. Will these funds get down to these prices? Probably not. In a down market, I get paid a little less, but I get to average down. Now, here's a little caveat that I want to throw in this month than any other month. Once it gets back up to my new cost basis, I'm not going to reinvest back into like a SPY-I or a QQQI or any other funds. So no reinvestment afterwards. I'll just go ahead and continue to build out GPIX and GPIQ with those distributions, or half of those distributions. I've been taking 20%, but I'll start taking half. The other 50%, I am going to put in to some kind of cash alternative and just have it sit there. And I'm going to track it. So when SPY-I drops 3.5% below my cost basis, I'll have a bunch of money and I'll buy some more shares. Same thing with the rest of them. Now, GIAX, FEPI, AIPI, and SPY-T will get a haircut. When they get above my cost basis, I'll just shave them down a little bit, take some of that cash, put it in GPIX, put it in GPIQ, and maybe I buy some iSpy just to keep it flattened across the board to all the different funds. And you say, Brad, why do you do that? Well, some of these things are getting pretty big as a percentage of my total portfolio. And that is why I just want to hedge down a little bit as we go forward, especially the larger payers. Keep them around the 3 to 4% maybe for a percentage of the total portfolio. Love the high payers, but there's a little more risk to them. At least there's a little more perceived risk to them. But that's just fine. I think going forward, I'll be just fine. But let's throw some of these up on a chart for you to see. FEPI, 1572. The yellow line is my current cost basis. 1572 doesn't come up on the chart. There you go. Not even on the chart. Yellow line is my current cost basis. We'll get back up to the yellow line. Not today, not tomorrow, not next week. But one day, it probably will. And keep in mind, every month, that line will come down. I don't know, 8, 10 cents per month. Let it come down. other one goes up, everything is just fine. Take my 8% and reinvest the rest. GIAX has to get down to $6.40. Well, look at there. There's the yellow line, and it's going to continue to go down. You can see how far away I am. It's not that far away. SPY-I, wow, SPY-I and QQQI. You can see the prices, 33.18 and 33.53. Yeah, just to say it's not going to hit those prices anytime soon. And we're getting back up to the yellow lines. Those yellow lines will come down. Once I get above those yellow lines, I will not be reinvesting back into the funds. I'll just take the extra cash, put 50 of it percent into GPIX and GPIQ to make those a larger holding. That's all I'm doing. Spreading the wealth, make sure one fund doesn't get too big as a percentage of the portfolio. Now, Bitcoin. Everybody should know, if you're not new to the channel, that I say you should have 3 to 5% into Bitcoin. And I just showed you I bought baggy. Well, let's just say baggy is just like about yay big to BTCI. It doesn't even compare. I like BTCI because of how much a percentage they write on there. But I'm going to just go ahead and stipulate this. Bitcoin is going up with the M2 money supply. If you're not following that, you should be following that because I've only been talking about it for, I don't know, 6 months. But anyway, it's going up with the M2 money supply. Normally what happens at this point of the season is in the next 70 days, we should see Bitcoin hit a new all-time high. Might be even sooner than that, but that's normally what happens. But at 110,000, I am not investing any more money into BTCI or Baggy or any of the others. I'm going to take it all, have it sit on the sideline, and wait for the price to come back down. That's what I'm going to do. And I'm going to take my 8% and live on it. But until that happens, just let it go. Let it go up. And maybe one day, 10 years from now, I can just live off of my BTCI holdings and never have to worry about it. But I'm not reinvesting as it gets higher than my cost basis. Now, last thing we're going to talk about is recession. So since 1950, we've had 11 business cycles that went into recession. Yes, we did. The market slows down enough, we can go into recession. Now, you can see the average length of recession duration is 11 months. Oh, wait a second. Didn't Brad just say that he has 11 months sitting in cash? Yes, he did. I think you just saw the picture. I have the average duration of a recession sitting in cash. But no big deal. It gives me the opportunity to average down. That is what I'm looking for. Who wants to buy at new all-time highs? One day, we'll get to new all-time highs. I'm looking for the opportunity to average down a little bit because you need to average down. We'll talk about this. So S&P 500 total returns after 2 quarters of negative GDP. And that's the definition of a recession, 2 negative quarters of GDP. Well, 3 months it's 3%, 6 months it's 12%, 9 months it's 18. You see the graph. So hopefully we get a few months of negative GDP. So in 3 years afterwards, the market will be up 46% on average, just to give you a longer term thought. And as long as I can get my 8% over those periods of time, do I really care? I can answer that for you. Probably not. The answer is no. So one thing that they talked about, this came from Fidelity, is the chance of a 12-month rolling returns exceeding CPI. So what they actually said was, hey, look, for diversification, you might want some floating rate loans. So what's floating rate? Oh, what's that? CLOs. Amazing. How did I guess that? Where did that come from? That comes from Fidelity. There you go. So you might want to consider credit and floating loans, especially in inflation, because the Fed thinks there's going to be inflation, but they're going to have to lower rates. So you can see credit spreads going up. Long term, it's probably a good bit. It's probably a pretty good bet, but everybody's looking at the short term. They only look at price today, or price last week, or price this week. What's going on that week? Who cares? It's a longer term duration bet. I actually told somebody I wanted to buy a fund that it was $100,000 to buy in, and I was only allowed to sell it 4 times a year. And then you're get in line because they're only going to sell 5% of the fund every single time those 4 times of the year. So I don't have to worry about price fluctuation every single other day. Who cares? I get my percentage. But that's just me, because I know what I'm getting into. But unfortunately, that fund really wasn't for me just because of the high buy-in. Now, performance during inflation ranges. I thought this was an interesting chart. Real estate. You can see during high inflation, real estate do very well as a percentage. And you can see they do very well between the 2 and the 5%. Gold ends up doing better, 3 to 5, than actually over 5%. You can look at treasuries and short-term treasuries, and you can look at the S&P 500. The S&P 500 does better when inflation is lower. And then small caps, IWMI always do better during low inflation and not high inflation. And again, that came from Fidelity, just for something for you to think about in your portfolio over time, and risk, because there's always risk in the market. So hopefully this gives you entertainment and education of what Brad's doing and his portfolio. So until next time, God bless.